Hi, my name is Sahana Rodemar. I'm currently a junior at Walter Payton College Preparatory in Chicago, Illinois, and the company I've chosen for my stock pitch presentation is Tesla. Tesla is in both the automotive and energy generation and storage sectors. Tesla's current share price is $259.16. However, the fair value target price I calculated for the company was $189.81, a 26.8% downside on the current price, supporting my recommendation to sell. Tesla was founded in 2003 in San Carlos, California. Tesla has expanded both internationally and nationally, with 1,359 total locations worldwide. Tesla is currently split into two sectors of business, automotive and energy generation and storage. Their automotive sector makes up the majority of their revenue, with this sector making up 74% of Tesla's revenue in 2024. The energy storage and generation sector makes up the remaining 26%. Tesla's current sales by geography are 48.85% of sales in the U.S. and 51.15% of sales internationally. As shown by the table below, majority of international sales are in China, with the remaining international sales scattered throughout Europe and Canada. The key points for my recommendation to sell are fierce international competition, shown by BYD surpassing Tesla in 2024 in terms of revenue and sales due to their advancements in technology, consumers' perspectives given the recent controversies and protests surrounding Elon Musk causing consumers to boycott Tesla, an extremely high PE ratio of 129.3 indicating a possibility that the stock could be overvalued, and finally, Trump's auto tariffs, which may affect production costs and profitability for the company. The electric vehicles business has been showing rapid growth over the years, and the market value is projected to reach $784.2 billion worldwide in 2025, with a compounded annual growth rate of 6.01%. China has remained dominant in the EV market, as shown in the bar graph above, where China represents the red bars and is shown to have more EV sales than Europe, America, and Canada combined. I identified Tesla's economic moat as a narrow to medium moat due to the following reasons. Firstly, Tesla is currently threatened by intense global competition. Tesla once dominated the EV market. However, recently, BYD, a Chinese company, has surpassed Tesla in both revenue and sales. Shown by the graph below, BYD currently holds above 20% of the market share, while Tesla only holds roughly 10%. Secondly, Tesla is at risk of losing its loyal customer base. Though Tesla does have intangible assets through their intellectual property, the brand's reputation is currently being negatively affected by controversies surrounding Elon Musk. Reputation and customer loyalty are also considered intangible assets and a competitive edge, so the loss of these indicates a narrow economic moat for the company. Finally, Tesla's low production costs given their vertical integration business strategy does give them a competitive edge. So for those reasons, I still believe Tesla has an economic moat of some level, even if it is a narrow one. For Porter's 5 forces and bargaining power of customers, I gave Tesla a 2 out of 5, indicating a moderate level threat. This is because there is a large amount of brands expanding into the EV market, so consumers are met with several alternatives to choose from besides Tesla. For intensity of competitive rivalry, I gave the company a 1 out of 5, indicating a significant threat, as brands with strong legacies such as General Motors and Toyota, as well as newer brands with promising technological advancements such as BYD, threaten Tesla's dominance in the industry. For bargaining power of suppliers, I gave Tesla a 4 out of 5, indicating an insignificant threat, as Tesla owns a majority of its supply chain, meaning it rarely has to rely on third-party suppliers. However, for key components such as semiconductors, Tesla does have to rely on the limited suppliers in this aspect, making suppliers' power not a completely absent threat. For barriers to entry, I gave Tesla a 2 out of 5, indicating a moderate level threat. While many legacy and high-tech brands are entering the market, it is still difficult for newer brands to enter the market due to a large amount of capital required. Threat of substitutes was one of the most interesting forces to analyze, as research shows a rise in the market share of plug-in hybrid electric vehicles compared to battery electric vehicles, which is Tesla's specialty. Additionally, migration patterns show that consumers who previously drove gas engine vehicles tend to prefer switching to hybrid vehicles rather than electric vehicles. So in both of these aspects, Tesla is threatened by substitutions. However, Tesla is still dominant when it comes to battery electric vehicles, so they do have some leverage in the industry. In my financial analysis of Tesla, I found that Tesla had a 5-year average of 21.6% for their average gross profit margin. For their operating profit margin, I found that Tesla had a 5-year average of 10.33%. However, this has been declining in recent years. Both of these 5-year average margins are fairly average given the EV industry's typical ranges. However, both of these margins are considered low for companies considered as high-growth companies, which many analysts consider Tesla to be. Additionally, Tesla's revenue growth rate has been dropping significantly over recent years, hitting a low of 0.95% in 2024, and Tesla's EPS growth rate has also hit a low in 2024 at negative 34.61%, indicating potential profitability decline within the company. For my valuation of Tesla, I initially used a DCF model. However, I reached rather low target prices in all three of my cases, my base case, bull case, and bear case, as shown below. I determined that this to be most likely due to Tesla's high calculated weighted average cost of capital of 15.22%. For this reason, I chose to use the PE ratio method instead. I decided not to use a comparable company analysis because Tesla is a highly unique company that falls into both the automotive industry sector and the high-growth technology sector, meaning it is difficult to find companies to compare Tesla to. The forward PE ratio I chose to use for my calculations was 92.59. The EPS projection I chose was 2.05, which is near the lower end of analyst predictions because I wanted to fully calculate the risks involved with Tesla. The calculated target price I got from multiplying the forward PE ratio and the EPS projection was $189.81, representing a 26.7% downside on the current price. These are my diluted share count and weighted average cost of capital calculations. I took a weighted average of the cost of equity and cost of debt for my weighted average cost of capital calculations, and for the diluted share calculations, I added the restricted share units, the basic shares outstanding, and the net dilutive options. Here are my projected growth rate and values used for the 5-year DCF model. Potential investment risks identified are a high PE ratio, shown by Tesla's extremely high trailing PE ratio of 129.16 and high forward PE ratio of 92.59. Shown by the graph below, this forward PE ratio is 9 times the average of the next 25 automakers with the highest PE ratio, and around 2 to 3 times higher than that of high-tech growth companies. This could indicate potential overvaluation. Furthermore, ongoing protests prove to be a potential investment risk, as ongoing Tesla takedown protests are currently negatively impacting the brand's reputation, which may not only impact future profitability, but may also lower investor confidence. Lowered investor confidence could lead to a selling of shares, creating an extremely volatile stock. For my ESG considerations, I found that Tesla ranked in the 33rd percentile, indicating a relatively low ESG score. This is mainly due to the social and governance aspects, as Tesla has done a lot to positively impact the environment. Tesla has had a large impact on mitigating pollution and promoting cleaner air and a healthier environment, and Tesla has also expanded into the market of solar energy and clean and renewable energy, shown by its energy storage-focused products and its solar panels. However, Tesla has faced several allegations, including poor treatment of workers in the workplace and labor law violations, and in 2023, Tesla was sued by the Equal Employment Opportunity Commission for allowing racism in the workplace in the form of hostility, violence, bullying, discrimination, and racial harassment. Furthermore, controversies surrounding Elon Musk and his role in contentious governmental affairs has greatly negatively affected public perception of him, and thus has resulted in a lower governance rating for the company. The growth in popularity and development of AI is extremely impactful for Tesla in terms of opportunities and long-term ventures. Tesla's new ride-hailing service venture, the Robotaxi, is a completely autonomous self-driving vehicle, which is only possible through the usage of AI and machine learning for Tesla's software FSD, meaning full self-driving. This technology relies heavily on AI to act as a pair of human eyes and visually process surrounding information through cameras along the car. Furthermore, Tesla has also used AI to develop a battery management system in their vehicles, solving a long-withstanding problem of battery degradation within electric vehicles. This system uses AI and machine learning to constantly analyze and monitor battery health, allowing the system to adjust energy consumption and optimize battery life and efficiency. Thank you for listening. Any questions?